Hello, everybody. Welcome to week 52 of 2025. The year's quickly getting away from us here, but this is the Build Weekly Roundup. You've got myself, Cameron Otsuka, and as always, Matt Dines, here to talk through the three topics that we've identified, key trends to be aware of and watch. As we head into the end of the year, I think you're going to continue to see a lot of the trends and themes that Matt has been calling out, that we've been calling out here on the show, continue into 2026. We had a discussion yesterday over some drinks about whether or not we should do a roundup episode, 2025 year end, what happened in 2025 type of show, but we've decided instead to focus in on kind of what's ahead of us in the next couple of weeks instead of trying to put down predictions into 2026. So if people are interested, definitely hit up Matt or myself on X. I think Matt is always more than happy to share some of his opinions there, myself as well, and we'll do what we can. But with that said, let's go ahead and get right into it, especially given that tomorrow's Christmas. I know Matt wants to probably get back to his family, myself as well. So let's do it. First topic here, as we go
Let's
through
roll it.
metals melt up. We'll touch on this briefly. I think there's been a lot of, let's call it, dismay in the Bitcoin community when they're expecting these, huge rip ups every 4 years, and it doesn't happen exactly as they're expecting. There's a little bit of a reality versus expectations mismatch there. Number two, where we'll spend most of our time on today's episode, CFTC allowing crypto as collateral for derivatives trading, something that I think that is extremely important, has been going a little bit under the radar in the broader crypto and specific for us Bitcoin space. And then finally, my favorite image here of Ursula von der Leyen. I have to shout out the original creator. His name is Levels.io on X. Go ahead and find his post there for where I got this image from. But the EU and the US kind of confronting over free speech, or at least speech on platforms. So I'll leave it at that. I think we'll get into more of that as we get there. But let's just start with metals. Matt, you've touched a little bit on what's going on, kind of why are you seeing this kind of big split in terms of expectations versus reality in the Bitcoin community. I want to just pass it over to you. What are you seeing in metals, and why is that kind of driving the topic, the headlines over the last couple of months?
Yep. So I'm not going to get into the depths of mechanically why metals are breaking out in terms of the exchange. There's a lot of interesting stuff going on the geopolitical front, right? We've talked about the breakdown of the world order from a unipolar moment, consolidated and tightly connected financial markets, which includes the financial side of settlement of the global commodities trade. I think the key thing to get in here, what was 2025 and like the historical record, what's going to go down on, what was most important this year on the financial footprint. In my opinion, it's the breakage of metals pricing mechanisms from the legacy, kind of just call it the old world order at this point, post World War II to 2020. London cleared derivatives contracts, futures, etc. For it started with gold. Well, actually, it started with LIBOR. We killed LIBOR, moved that interbank market, and all of the settlement activity for the collateral layer in the U.S. dollar, like on the financial side of international trade, moved over from Europe and or London centric towards the United States. But we've been seeing as 2025 has played out, the gold bull market, that really started in, you could say it bottomed in with like right about the time of the FTX event, which was what, Cameron, November 2022. 2023, that bull market was starting to pick up steam. It was really clear in 2024. Once it broke through that 2000 level, it was off to the races. But gold just continues to be in a historic up move, which tells you a lot about what's going on in terms of international collateral for settlement of trade, cross-border trade. what's going on there. But I think 2025, the key development, what's going to go down is the breakage and the metals themselves, like just broadening across the board from gold into, you've seen it in silver, you're seeing it in platinum. Just pick a metal. It's probably
Which is
the
this
chart
chart here.
looks like you're seeing a technical breakout, copper, etc. But I put platinum here because from the Bitcoiner's perspective, most of us, or you could say the crypto crowd too, like a tangential movement who we think are in my opinion, probably Cameron agrees. He definitely agrees with us. We talked about this, but a misguided fork of the Bitcoin adoption wave, in my opinion. But this is what your 4-year cycle kind of maximalist would have expected for something like Bitcoin to do in the late stage of the halving cycle dynamic that's played out prior 3 times. And I think everybody was looking for that pattern to materialize. It didn't in Bitcoin. And I think that's why, you're seeing things. I put out a tweet this morning or an X post. I don't know if you can still call them tweets. Um, it's kind of resonating. Just the sentiment in Bitcoin right now. You hear a lot of influencers who've been here for over a decade. Um, just calling out how low the sentiment right now stands, and you see it kind of showing up in 2-3 months ago, right? It was the what was the op return battle
Yep.
internally.
Filters.
That one seems filters put to rest. Now it's quantum, but it's just in this moment right now where um, Bitcoin's in that place where I think a lot of people are going to go through and update their models, not tear down or revisit, because I think everything uh, is largely just structurally intact. The core value proposition of Bitcoin, the long thesis, all of that. But I think some of the weaker assumptions that get piled onto that aren't actually, grounded in reality, such as just pattern recognition things like, oh, the 4-year cycle, or I don't know, we could name other ones.
Rainbow
What
chart or
we need to
whatever.
change
Yeah.
Bitcoin, stuff, rainbow charts, yeah. You know, mental maps are, it's kind of that thing, the map is not the territory. And I think what's going on in the metals is a good opportunity for the Bitcoin kind of longs, the investor base, who are here for the long haul, to update their thesis. Like look to the metals, what's going on with that trade. When I say trade, yes, there is some element when you compare to other people, their performance, if they're just a gold miner investor or something like that. It is one of those end of year things where I think people do compare to their neighbors, right? You only feel as rich as you are on a relative basis to the other houses on your block. I think is sadly the way just humans tend to compare themselves. So with Bitcoin having a flat to down year and metals breaking out, I think it's just a time for reflection, but really it's an opportunity to put some more muscle on and come back with a bigger, better foundation for what's ahead. We'll get to that in a second. But in terms of what's structurally breaking here, the the venues where pricing of global commodities takes place, right? We talked about in the past the importance of sea routes for international trade. Um, a lot of things involved here. Importance of naval power. You're seeing that play out in other stories that we cover on a week to week basis, like the Venezuela situation. We
The
won't
whole
touch on
thing.
that this week,
Yep.
but the the venue where the commodities get priced is a key kind of power hub for, I guess what you say, just geopolitical and financial power, right? And historically, under the previous, let's say, 500 years era, starting in 1492 and continuing to this day, um, under the European colonial model, the pricing mechanism, especially as that European power shifted um, from, let's say, like the Habsburgs, the Spanish Portuguese Empire, and they traded off. They handed off power starting in like the 1600s, and it went to London and the Anglo-Dutch Empire. that center of just price clearing and price setting really lived in London, and I guess you could say a little bit in, um, you know, continental Europe more broadly, but mainly London, right? And so all of that international trade, Europe trading with Asia or Southeast Asia, US, trading, same places, all of that, that center of gravity has kind of always held for 300, 400 years. And it is like the powerful ring that is wielded like in the Lord of the Rings series, right? Um, and what you're seeing in the metals right now is largely a breakdown. The start, we losing LIBOR was the start. Then, really in 2025, um, it became clear there was something going on in gold, and with the movement of the physical gold itself from European vaults, London vaults, Swiss vaults, et cetera, and making its way into New York and Shanghai, as centers of power where the gold was held. Now that pricing mechanism is also breaking down, and it's showing up in other metals. So that pricing power is moving from, let's say, the LME to other markets more broadly, whether it's the COMEX in the U.S. or out of Hong Kong and its counterpart. I think what we're really seeing here with this metals markup is part of this bigger transition we've been talking about all year, that's underway, not just on the geopolitical front, but in money more broadly, and where the rubber meets the road. Like when you think about um, trade, like in goods and services, right? Money is one half of the trade, but on the other side of that is the actual transfer of value, which is in the good or service itself. And at the bottom of the stack, the lowest level, like in terms of value add, your starting points, by definition, those are the commodities, right? So we're really seeing a transfer of where the pricing of value takes place on a sovereign standpoint. And I think our core thesis here, that we hold to as we kind of view the tape and follow what's going on our weekly roundup,
Yeah.
Cameron. I think the core thesis, what we do know. I don't know ultimately where it may settle out between New York or China, Western Hemisphere versus Southeast Asia. But I think it's pretty certain that the power that Europe had or held over the globe, under that peak era, the second half of the I don't know what the word is, second millennium, I guess, like 1500 to
Yeah.
2000, 2020-ish. Um, the world is shifting, and you're seeing that right now. So, yeah, what we're seeing in metals, I'd call it gradually, then suddenly, that is what you're seeing on this chart. Is every Bitcoiner is familiar with these things happening. Now, this doesn't mean, uh, the Bitcoin adoption cycle, all of that. It's broken, etc. Just means you're in consolidation. It's not its time right now to make a run on the chart. So that day will come. But yeah, I think that's what I was getting at in a tweet that seemed to really resonate this morning. It's talking about why sentiment right now is really on the floor in the Bitcoin space, which is also generally a good sign. This is when you want to be building and entering, or making moves is generally the best time. When everybody is euphoric and bidding up prices, generally not the time to be launching new businesses, conducting acquisitions, all of that. So actually, the bearish sentiment in Bitcoin, if you're really along, and in it for the long haul and high conviction, um, it's actually a good thing for you, in my opinion. So we'll leave it there. If you want to learn more about what's going on in metals, I am not an expert here. You're talking to people who actually interact with the futures market, take physical delivery, all of that stuff. Um, that's not my background. I just know enough to um, kind of just keep my ear to the ground, know what's going on, and see how this affects fixed income markets, et cetera. Um, but someone I recommend here is Vince Lanci. His Twitter handle is Sorenthek, Sorenthek. He's on Twitter. I mean, right now this is his bull market, and just followers, like what's going on in metals. This is right up his alley. So it's his 15 minutes right now. Some of his stuff, like his Substack or X subscription feed, might be behind a paywall, but there's enough out there. Go search him on podcasts, and he'll get you plugged in to understanding what's going on in metals if you want to understand that deeper. So I'll leave that one there. I think that puts a bow on it. But 2025, in my opinion, Time Magazine put AI on the cover. I think that was late. Maybe 2024 was the AI year. 2025 should be metals front and center. And it's, last night we were talking to, a couple people we didn't know. I just wanted to ask people like on the street, not in our industry, um, hey, do you know what the price of gold is? What the price of silver? There's a general sense like, oh yeah, gold's high right now, silver's high, but there's no depth of understanding in terms of what's going on in the big picture context. So this is still not trickled in with the general public, in my opinion. And I would also add to that just the broader financial investments, profession in general. I think it's still relatively early in these things taking shape. And this is after, the changes on the plumbing end and settlement and delivery mechanisms and the pricing structures of metals and commodities, like getting underway since 2013, 2014. So it's slow moving, and then things change very quickly. But this is a huge story, in my opinion. That's only just starting to get the appreciation it
Yeah,
deserves.
well, and I think speaking to this idea of changing the plumbing, right? To go to our second topic of today, the CFTC just announced. Hey, I'm doing multiple things here. The CFTC just announced that they would allow for a pilot program for using BTC. They specifically call out BTC, ETH, and USDC as collateral in derivatives markets, and also issued guidance on tokenized collateral. So, Matt's been talking a lot about these changes in the underlying structure of our legacy financial markets. I know he's going to want to go into detail on this, but I want to call out here, here are the two staff guidances. You can go look these up. I'm going to just kind of highlight these here. Tokenized collateral guidance, and then this one I thought was really interesting, a staff no action position regarding digital assets. Essentially, they had a compliance question from a regulated entity
Mhm.
saying, "Hey, we want to be able to utilize these digital assets. You know, CFTC, do you have any specific guidance here?" And the no action, you're never going to get a yes, go ahead, go do this. But the no action is effectively the way that they would do that. So, Matt, I'm going to flip it over to you here. You had some, I think, key insights that you were able to pull out based off of some of the research you've done. But in your kind of framework, how does this affect the legacy financial plumbing by enabling Bitcoin, stablecoins, et cetera, as collateral?
Yep. So the CFTC action and there's
Yep.
three letters, I think that they issued that bundled up. And then the key output of that is, as Cameron, you got it in the headline, there's going to be a pilot test launch of a program that allows, they call them
Yep.
FCMs. The exact acronym, it's Futures Commission Merchants, maybe, or Futures Commodity Merchants, I want to say. What are those things? They're basically like the equivalent of a broker dealer in securities. They're that base layer between like or that middleman, sorry, between the exchange where everybody just meets and the um, I guess in the physical version of this, these don't exist anymore as everything's moved digital, but like the open outcry
Yep.
exchange pits, right? And then those individuals or FCMs trading on the pits are ultimately conducting the trades on behalf of their accounts, right? Client accounts. They can also trade for the firm or the house themselves. Um, but that's what this is. So they're going to launch a pilot program so with a futures or a derivatives contract, what you're doing is you're 101, you're engaging in a transaction that will settle in the future, right? So you have something, could be a security. You can trade you can do S&P 500 futures, right? You can do fixed income futures, interest rate futures, currency
Or
futures, or you can do
yep.
commodity futures. Yeah, and that's where the metals comes in. And yeah, so when you want to engage and just take a side of a futures contract, you match up with a counterparty, taking the opposite position. You know, it's someone's got to sell if you want to buy, or vice versa. Um, but what people do, or what the exchange requires you to do on the back end, is post collateral, right, for margin, and you can actually lever up. You have, 100 nominal dollars worth of product that your futures position says you're going to settle. You may only need to reserve or hold like $10 in collateral behind it, and really that's just to get the price moves netted out on a daily basis, so that you're not building up credit risk between counterparties. Like that's what the exchange provides services on the back end, is for um, that counterparty netting on a day-to-day basis, just due to price moves in the contracts that they've agreed to against spot market prices. Um, so in the US, like you can go to the CME, they publish everything, like just the list of assets that they'll allow for collateral by these FCMs, and the haircut, right? So if you post, let's say, a treasury bill, you will take a 0% haircut, like it's dollar for dollar money. It's money good. If you post gold, I forget what the number is. Maybe I can't remember. I did a talk on this last year at the space in Denver, where we went over this. And that number for gold, maybe 85%. I can't remember. That might be the new Basel III guidelines. But CFTC and the futures exchanges, they have their haircuts for all of these assets, corporate bonds, other sovereign bonds, et cetera. And they'll tell you, hey, here's how much we'll count that for as in terms of meeting your margin requirements. This pilot test, the significance here, it's not the first one. The US is not the first sovereign regulator to allow, like, call them cryptocurrency assets as collateral, right? But the US is both the largest futures market in the world, and its approach here to integrate native crypto assets. What I mean native, that technically they're the only crypto assets in my view. But you start with Bitcoin, and then they also say they'll include Ether, stable coins, right? Because you gotta get consensus to get changes made. And the sad fact of the matter is it's a much bigger consensus. It's a bigger tent when let's say the stakeholders push for regulatory changes. Once you add in the crypto bros and the venture capitalists who come along with them, sad to
Right.
say, but it just is it is what it is. But the CFTC, I'm just going to say Bitcoin here from now on, just because my house view, that's what matters. Um, they are going to integrate with and allow for Bitcoin collateral directly to um, to serve as or to operate as assets, providing the margin requirements and backstop behind the futures transactions that take place on the U.S. exchanges. Any questions so far, Cameron?
No, I think, from my
Okay,
perspective too, like a big thing here is not having to convert that Bitcoin into something else also, right? So if you're
true.
seeing all of this, there's been a lot of noise made about some of the stable coins being used as actually just a way for people to, use the crypto rails to be able to trade crazy derivatives or
Yep.
whatever it is. This is saying you don't need to go do all of this, you know, wash trading, whatever it is, to get into a coin that you can then use as
Yeah.
collateral. You can just do this with the native Bitcoin rails.
Yep. You'll have to, I mean, it's the real thing. It'll be
Yeah.
collateralized with UTXOs. But there may like you're not just going to be able to, show up to the the building in Chicago and post your cold card or
Drop your cold
your
card on the
ledger and say
steps.
I'm good for this. No. You'll probably have to custody it with a qualified custodian like a bank, broker dealer, etc.
Yes.
But it's coming. Um, Now, the US isn't necessarily the first to do this. So you've actually seen two other markets already go and kind of get a head start. The key thing here, though, is the US represents, I already said it's the largest, futures, derivatives, and swaps market globally. So the value already lives there. And then it's Bitcoin, right? So it's porting that onto Bitcoin. I'll go over what that means in a second in my framework. Two others that did this with digital assets, right? You had Dubai with its VARA, Virtual Assets Regulatory Authority framework, launched in 2023, 2024, but it's tiny. Like there is not much, futures, commodity, all of that trading out of Dubai. Claims to be the capital of capital, the upstart. Like it's kind of the region that if Europe and the London banks had their choice, they would want the center of gravity to move towards the Middle East and Dubai, as opposed or Abu Dhabi, Dubai, I would say, just UAE, period, as opposed to that center of gravity shifting towards New York or Shanghai. But it's small and it's digital assets themselves, which is I view this as a $10 fancy word for just saying it's like private blockchains, whatever. It's not solving the fundamental core problem or offering the solution that Bitcoin is as an open, um, censorship resistant, you know, ledger money that solves the Byzantine generals problem. Like, so this thing we're going to put tokenized real world assets, other digital assets, all that stuff, and they're going to collateralize tokenized securities, stuff like that. Um, it's a different approach. You're not plugging into the thing like the network effect that Bitcoin's already built up, and then you're also not porting over a massive amount of value that's already established and where just stakeholders across the globe are engaging with each other as financial counterparties for settlement um, in the United States already. So Dubai first, but they're different, small, and they're not even doing it on Bitcoin or call it native cryptocurrency. When you see that, just scratch that through and say Bitcoin, and you'll see the signal through the noise, in my opinion. Then Hong Kong as well with its SFC, the Securities and Futures Commission, began this VATP, virtual asset trading platforms, just product launches. Um, but it's the same thing, very similar. It's virtual asset derivative trading. Um, like in my view here, you're trying, like what these approaches are trying to do is look at a new technology like Bitcoin itself, and then trying to copy paste that technology onto something different, create a new use case, not realizing that the actual new technology, the only thing that matters really of importance is Bitcoin itself as the protocol for settlement and counterparty free custody. So those two are the ones that are already off for the races. Now, the US is the first major, I would say, to adopt. And its policy approach, everybody's got to come up in this new world, right? Where, the table just got turned over. Everything's up for grabs. After 2008 was really the starting point. But you're seeing the US make the policy decision. It's going to build on Bitcoin. And then they also list Ether and stable coins in there, which, in my opinion, as this goes on, those will become less and less relevant. Um, Now, for the other majors, you see they're in sync or trailing. You have Japan, where it's tested a proof of concept but it's focusing more on the tokenized, its regulatory leadership is focusing more on the tokenized securities approach. So just, hey, let's tokenize the stocks and bonds. Um, and then the United Kingdom, um, which is focused, if you think about UK, right, just look at its politicians, look at King Charles, you'll hear them say tokenized real world assets are RWAs, right? So from this approach, what you're thinking of is, oh, hey, we've got some forests and timberland up in Canada, or hey, Calgary or Alberta, you've got some oil and gas assets. Let's just, slap a claim on those. We'll throw it on a blockchain and we'll call it a tokenized asset, whatever, and we'll trade it like it's, an Ethereum or Solana or all this stuff. And that'll form the basis, the collateral basis of our futures, swaps, and derivatives markets. So I think if you're really looking at this from the zoom out perspective, each one of these sovereigns has to come up with a policy, right? And in the fog of war, everything's confusing. But the fact that the US is aggressively focusing on, what I guess in the broad sense, the word for this is the crypto native assets, like Bitcoin itself. Um, that's that's actually the foundationally correct move in my, you know, prognostications of how this will play out. Um, so it's an extremely positive development for U.S. Centric policy when you're looking at this broader, I guess, conflict that we're discussing pretty much on a weekly basis with this regionalization and geopolitical conflict. All right. So in terms of like first mover, US wasn't first, but it's the first to get it right, I think is my big takeaway. And then it's also first because or in the sense that it is the largest. So in terms of like notional outstanding or total scale of swaps, futures, derivatives, just all these paper contracts out there, the US is the global behemoth. It's just a quick search. I think, where is this from? I think this is an ISDA number. But there's 250 to 300 trillion dollars in notional derivatives outstanding. Um, and all of that has to be collateralized by something, right? And in the old model, it's just, the snake eating its tail. Everything's collateralized by debt. The debt the debt itself is the asset, and we just rinse repeat, grow this bubble, and you're just building up a house of cards on a very weak foundation, in my opinion. That foundation like just buckles every time you see a financial stress event, 2008, 2020, etc. And what you're seeing everybody move to do, from a sovereign standpoint, is kind of take steps to shore up their foundation, pour more concrete, get a little bit more, rebar, etc. Um, and in the future, as these key players, these regions compete amongst one another and trade with each other. The ones that get it right and build that solid foundation for the financial system will be where the capital flows, in I'd say the centuries ahead. So in term, like another call out here, I think something interesting. So futures specific volume, the CME Group's U.S. Treasury futures alone trades an average of $774 billion per day, according to 2024 data. So if you think about all of this, the $38 trillion national debt, why does the debt need to keep going up? It's because that is the base layer collateral in the legacy framework, not just in the United States, but in, London as well. We'll get into that in a second. But this CFTC pilot is basically, the text here calls it a 0 to 1 moment for crypto, but really for Bitcoin itself, but then also the financial structure that's built on top of that. I think the other key thing here For the US, it like the policy approach it's taking, it doesn't have to start from zero. We're just going to, rebuild. There's still, probably law that needs to get done. We might need an update to the 40 Act. I'm not not a 40 Act lawyer, not a professional, but there are I guess just questions, just gaps in the legal interpretation, regulation, all of that. That's going to need to be patched for this kind of novel invention that showed up on the scene in 2008. But I'm confident that will get done. And like basically what you're going to see is adoption of this Bitcoin technology on the United States, financial framework. So what we talked about was sentiment. Hey, why isn't Bitcoin going up? It's actually been in a consolidation now for going basically a year since that November 2024 election. It's not quite yet Bitcoin's time in the cycle for that up move that you're seeing right now in platinum, copper, silver, gold, etc. But its day will come, right? So, oh, I guess I'll just one more sentence here. Even like a tiny fraction of this collateral market, like you've got all these derivatives, 250 to 300 trillion. Those have to be backstopped by real collateral. The actual preferred right now, the most common, it would be assumed to be U.S. Treasuries, right? The CME, the CFTC, they don't post like a list of, hey, what's being applied as collateral, or what are these FMCs actually posting? Um, but it's broadly presumed like it's going to be heavily treasuries. It's just favored. You get the best terms, lowest haircut, all of that. Largest market as well, most liquid. But over at some point in the last 5 years, the spot market in Bitcoin to US dollars, if you think about concentrated dollar liquidity in one asset, right? I think Bitcoin is on par with, say, a T-bill, QSIP, or like the 2 year, maybe not quite the 2 year on the run treasury, but trend, like the amount of liquidity in the Bitcoin to US dollar, FX exchange rate pair, if you think of it that way, it's already massive. So porting over Bitcoin into that collateral layer will have massive implications going forward on, I want to make a prediction or put a time on it, but the further you roll the tape forward, 1 year, 2 year, 3 years, the more important this comes as like that value transfer of the collateralization effect works its way into the 21 million Bitcoin supply. Um,
Got it. Do you want to maybe?
Comparison, yeah, go
I
ahead.
would say maybe we skip this next section. Do you want to focus actually on you mentioned the UK piece? I'm really curious
Yep,
about that. I think there's
yep,
you put together this global leaderboard. I want to put it up on the screen here for
yep.
everybody.
Yep. So the global leaderboard, this is 2024 notional numbers based on, this is just interest rate derivatives, right? So you're just comparing, swaps, calls, et cetera, on interest rates. And this is coming from the ISDA and BIS data. But it says United States notional volume, they claim approximately $366 trillion. Now that was, if you zoom out and what did the last number show? 250 to 300.
Yeah.
That might be market value. I'm not sure. But yeah, notional value up front would be, hey, how much, what's the basis for an interest rate calculation? So you take a few percentage points in terms of what's going to be settled. Um, and that's the actual like value transfer that would change hands between counterparties and an interest rate derivative, is how I would think those two numbers square up. But yeah, 366 trillion in notional outstanding for interest rate derivatives. It's dominated by SOFR and your Treasury futures. Now in second place, you've got, I mean, it's less than half. UK, 172 trillion. This is legacy. Like London was New York before New York became New York, essentially, in terms of capital market center of gravity. Um, and this is where, yeah, they lost their big product since the, you know, 1950s, 60s, the first LIBOR, you know, rate settings taking place between the major global banks out of London. Um, and then just the heyday of LIBOR indexed uh, credit products, so mortgages, et cetera, anything variable or floating rate between, say, the 1980s, once we got out of the 70s great inflation, um, basically from that 1980s period to 2022 when LIBOR was deprecated. UK owned that market. So what you're seeing is just a change of the top of the leaderboard, and the US is just running away with it, right? And then in third place, you've got the EU with 76 trillion. It's much smaller. You think about the UK and continental Europe, always being in competition with each other for just financial markets activity, capital, et cetera. And the old school kind of European colonial model, even combined, they're not even uh, at par with the United States anymore. So this is a big development. And everything you're seeing when you listen to the collateralization, like anything related to collateralization of futures, derivative swaps, et cetera, and the changes in policy that are going to take place, if it's someone out of the UK, you're going to hear the words RWAs, tokenized assets, all of that stuff. You're not going to hear Bitcoin. And then same thing out of EU. You're going to hear Christine Lagarde talk about the digital euro. We're introducing this novel product. It's going to be the best thing since sliced bread. It'll be online cash. It'll be offline cash. They don't even have a real product, right? They're selling against vaporware specs out of desperation, in my opinion. Um, but you can see this taking place at the collateral layer in the US, what we saw with that December 8th announcement and those three policy or staff letters rescinded in the announcement of this pilot program. You've seen, the number one, the lead horse in the race, they're going to collateralize Bitcoin. So huge development as this goes forward. So one more slide. I know I can kind of tend to get academic here. Let's go to
Yep.
14. Cameron, do I have
Lead you
control?
over.
Okay. So popular book, especially as, the tech companies started to dominate the US economy by the 2010s, it was apparent, right? Google, Apple, Facebook, Amazon, all of that. Um, this book, The Innovator's Dilemma, became really popular, not just in the venture capital community, but I would just say like the MBA program
I mean, it
minds
was
like
required
just
reading when I joined Amazon.
canon.
So, yeah, yeah.
Oh, really? Cool. All right, awesome. It's very academic, and I'm not sure that many people actually fully absorb what's going on here. But I'm going to try to explain it in terms of what we just saw with the CFTC adopting what I view as the disruptive technology, which is Bitcoin, right? So if you think about settlement products, like what is Bitcoin itself? It wears it right on its face out in the open. Pick your favorite metaphor, right on its sleeve, what it is. It's in that first Genesis block. Chancellor's on brink of second bailout of banks. It's um, it's a protocol where nobody can change the monetary parameters, which is basically just ensuring everybody's on an equal playing field. Your competition, your peers, your distrusted counterparties, you don't have to trust them. You just have to trust that this protocol credibly guarantees that no one else can change the rules, right? And that's at its core what it is. Um, Probably not the best explanation of it. We could go much deeper, and other people could do a better job than me. But in short, that's what's going on. And so if you think about the Clayton Christensen disruptive technologies framework, you've got a new technology that arrives, right? So if you go through his book, he'll talk about hard drives, right? And you go from magnetic tapes to spinning hard drives, then you get SSDs. There's always a new technology, and then you have um, I guess, the private sector coming in to build products on top of those technologies. And ultimately, what they're trying to do is deliver products or services that consumers demand in the marketplace, right? That's all you're doing. And so if you go on the y-axis here, you've got product performance, high to low. What does that mean? Just better products, right? Start with crappy, then they get better. Um, so over time, what you actually see is these technologies will show up as, people make discoveries, and they invent new things. Just what humanity is capable of. We're a creative species. It makes us special. And what you'll generally see is competitors in the same product market space um, come to adopt those technologies in their product mix at different times and to different degrees, right? And so at that level of the y-axis, the product performance, you kind of assume that what customers will pay for, they always demand better product performance. We want faster horses, better whiskey. There's a third one there in the old country song. I won't get at, but they just want better stuff, right? The consumer just always wants better. Same way like your car, right? The Model T started in like one color, like everybody got the same thing, and then eventually you put in air conditioning, power windows. Now you have an iPad. Now they self-drive. It's just customers always demand better features, right? Um, and so what the new technologies actually allow for is the displacement of the legacy incumbents who may not choose to adopt that new disruptive technology because, like there's various reasons. It could be the cannibalization effect. They don't want to put resources towards, changing their product mix to integrate a new technology, et cetera. But for whatever reason, they don't. And that's where the innovator's dilemma comes in. They eventually get to the point where they have to bet the farm and integrate a new technology or risk being disrupted, right? And that's why no one holds on to the number one position in a market share forever, right? In general, like track record's undefeated, same way Father Time is, right? So, in my view here, what we're seeing when Bitcoin arrives as a disruptive trajectory, right? What does it serve first, right? You start with like different tiers of the market. There's a low end, middle, high end, et cetera. Imaginary levels here, but in practice, where do you actually see this in the real world, right? Go back in time and think in like 2010, 2013, who was the product or the customer base that Bitcoin was actually serving as a disruptive technology? It was, the product was the Silk Road, right? Yeah. So you're serving the low end of the market, black market, drugs, generally like non-permitted goods, according to the state, in most sovereign jurisdictions. That was the first customer base that Bitcoin served. Probably the least profitable. It's the low end of the market. If you look at what Ross Ulbricht made in terms of Bitcoin profits in that phase, say it probably made a decent amount as like a tech startup, right? Um, but in terms of actual value transfer, it was nowhere near what like a settlement marketplace or like base layer settlement, like say the Fed was earning on its business, or you could also say other settlement products, or just treasury collateralized settlement, all of that, right? But as time goes on, you eventually see those incumbents make that choice of whether or not to adopt that disruptive technology. And as this whole process is happening, you're seeing new disruptors. So Coinbase is one of these FRMs, right? Who is a key party in this CFTC pilot program. They're going to be one of the FRMs, most likely, in this pilot program. So you get new disruptors. And if you also look at the financial firms sort of descending by market cap, Coinbase has really shot up that list. in the last 10 years, like going from startup to nothing. So you see examples where firms that adopt that disruptive technology um, outcompete incumbents, build new markets, build new products, etc. But then the incumbents that adopt as well will outcompete their peers. So that means, hey, if a bank in the U.S. is incorporating Bitcoin into its systems, all of that product mix, etc., it might compete or outcompete over time against its relative peer group of fellow U.S. banks. But you could also say that too for sovereign jurisdictions too, like financial systems themselves. The U.S. regulated financial system. What's the proxy for that? The U.S. dollar, right? Um, the onshore U.S. dollar, SOFR, all of that. You would expect it to outcompete other sovereign competitors, UK, EU, Shanghai, etc. Um, it doesn't have to be a winner take all either. You can have different sovereigns cooperating with each other, forming factions, teams, etc. Like we've talked about, U.S. plus Argentina, Japan, etc. You see nation states coming together to form alliances, and that's showing up in the headlines. But my opinion right now, this CFTC pilot program, if you're thinking about these lines, see those red lines, you see the incumbents sustaining trajectory. This is just the steady state. If the CME did nothing, they would eventually start losing market share to other competitors, right? But over time, that disruptive technology works its way up. It serves, 15 years ago, it was serving, just people buying drugs on the internet. Now it's serving mainstream audiences. You can find, just, do a survey of US adults and households. A sizable percentage of them own Bitcoin at this point. A lot of it's through ETF or synthetic exposures, whatever. It is what it is. And then it's working its way up to what I would call the high end of the market, which is ultimately going to be the international trade settlement. So, one example, we talked about this a couple of weeks ago, talked with the Russian oil divestitures, right? Value, like the key channels of value are international trade. Like you buy low and sell high, and you put the thing on a shipping container. Um, that is where a lot of the value transfer takes place in a globalized world, right? And then the CFTC, purview kind of represents, we talked about the commodity trading houses, right? And you think about, oh, who are the U.S. Ventures there? Well, number two is Castleton Group, which is owned by Paul Tudor Jones, probably our most notable Bitcoin figure. I know within Bitcoin, if you look at the follower index, you're just going to see Michael Saylor show up as the most widely followed and um, just making the most headlines advocate just for what he's doing with strategy and the equity space. But I think your highest signal Bitcoiners are the people involved in the finance niche of international trade, of commodities themselves, and then settlement and collateral. And I would include Scott Bessent coming from that world as well. So that's, Cameron, we said we're not going to talk about predictions for 2026. This may not be just a 2026 story. We're going to get the pilot off the ground, but this is a medium to long-term story. This might take 2, 3, 4 years to play out. But that's what this headline is showing, that Bitcoin is working its way up the stack in terms of ultimately serving the highest end and most profitable customers in the
Yep.
market.
All right. Well, final
Cool.
topic for today. Let's pivot a little bit, but we've got this what I call it, the announcement of actions to combat the global censorship industrial complex. So, I have some opinions on kind of what that actually means, but Matt, I'm curious to hear your take on this because from when I first heard about this, I
Yeah.
initially went to it's a sovereignty question, right? Are we going to allow other countries, other organizations to say, hey, you can't do that, XYZ in the United States, and free speech obviously being one of the easier ones, in my opinion, to say, hey, we'll put our line in the sand there. But Matt, in your purview, kind of what does this mean?
Okay. What was the headline? This was in like the last few
Yep.
hours, right? Um, so I think this would have been yesterday's news. The US issued sanctions reinforcing the red line I invoked. All right, so this is that was the
This
Marco
is
Rubio tweet, Cameron.
the Sarah Rogers tweet, but Under Secretary to Rubio, yes.
Okay. Okay, awesome. Okay. So what the US just did is censored five, I guess you call them EU bureaucrats, technocrats, whatever the right term is for this. But it's not like, or they say sanctioned would
Yep.
be the correct word. Um, but it's not sanctions like, oh, you're on the OFAC, yeah, block list for financial transactions. They can still deal with the U.S. banking system, et cetera. So they haven't rolled out the full big guns, right? These aren't pariahs on the same degree as Vladimir Putin. It's not that level, but it does mean they're not going to be permitted. They're persona non grata as far as like travel to the U.S. is concerned. So it's a big kind of move on the diplomacy scale, and the Department of State that Marco Rubio, heads and kind of represents. What's going on here? So 2022, I think it was. This is a von der Leyen era, policy initiative to launch the Digital
Mm-hmm.
Services
I
Act.
think so, yeah. I think it's
Um,
2022.
is that right, Cameron? The DSA? Yep. Um, but basically, what it was doing is cordoning off kind of the EU in terms of what could be said or tolerated on social media platforms or just online technologies, right? Um, these town halls that have opened up since or in the last couple of decades and gained broad adoption. So a lot of it tried to regulate kind of the US based tech companies themselves. Like the big tech companies tend to be largely from the US and out of Silicon Valley. There's some Chinese competition as well that's really um, started to gain steam. But by and large, the fight between the EU and the US has really been the big or the most confrontational, I would say. But yeah, what effectively happened in 2021, 2022, you had kind of embedded censorship, like basically crossing the Atlantic and working its way into the United States themselves. And so, kind of what this represents is, I view it as a spreading apart of former kind of roommates, if you will. The US and EU used to be friends, living together, everybody playing cooperatively, same way we talked about, the offshore to onshore dollar, right? We're going to, hey, offshore dollar, we're taking our ball and taking it home. It's kind of one of those things as well, taking like if you look at the story from that way. So the US is basically, with this move, maybe retaliation might be a good word for it,
Sure.
an appropriate word for it, against the EU for the actions it took in terms of fining US based tech companies and maybe over regulating outside of its own sovereign boundaries,
I mean,
right?
you can point
So
to like
it's a
GDPR as
battleground.
well.
This
Yeah.
isn't. Yep. Yep. Exactly. So yeah, I think this is a story that kind of highlights the broader fractures in the relationship between the US and Europe. They seem to be moving further apart at a time when the US is clearly going a different direction, um, from a financial system perspective and what it's going to build out for, its vision going forward. US has already, stated, made it up front with the national security document released a couple of weeks ago. I don't think we got into that, Cameron, on Weekly Roundup, but I talked about it with Nick Bhatia on the Bitcoin Lair. Just focus on the Western Hemisphere, and then from there, yeah, we'll do international trade, with Asia, Europe. We're open to it, but it's going to be under kind of a new arrangement, a new order, if you will. Um, so I think, yeah, this headline was big. We talked about what to watch for from a financial perspective when we focus on the changes taking place. Um, and money and geopolitics, but I think this action yesterday on the digital sovereignty is kind of a big event in the relationship between the like two key regional players in this new multipolar
Absolutely.
world.
Well, with that, I think that's a good place to leave it for this week. Like I said at the beginning of today's episode, tomorrow's Christmas. I hope everybody, if you celebrate Christmas, you have a Merry Christmas. Otherwise, take some time with your family. I know I will be doing that. I'm sure, Matt, you're going to want to be able to spend time with your family as well. Our plan is for next week to most likely skip doing an episode, but we'll be right back as soon as the new year turns over. Yep, as always, go ahead and like and subscribe on YouTube, on X, on LinkedIn. That really helps us out. If you have any suggestions on where else to post, I'm also open to that. I think Matt and I have been noodling on some maybe design changes, format changes as we head into the new year as well. So look forward to seeing some changes as we roll those out.